Hi guys, welcome to my channel. In this video, we will talk about poor man's covered calls, the best secret and options that are beneficial for beginners. So make sure to watch the full video. Let us start with the brief overview of poor man's covered call. The poor man's covered call is an options trading strategy that aims to replicate the profit potential of a traditional covered call strategy using a more affordable approach. It is particularly suitable for investors with limited capital or those who prefer a lower-cost alternative to buying the underlying asset outright. In a traditional covered call strategy, an investor buys the underlying asset, such as a stock, and sells a call option against it. This strategy allows the investor to benefit from the stock's appreciation while generating income from the call option premium. However, buying the underlying asset can require a significant capital outlay. The goal of the poor man's covered call strategy is to benefit from the stock's price appreciation, while collecting income from selling the short-term out-of-the-money call options. If the stock price rises, the LEAPS call option will also increase in value, resulting in potential profits. However, if the stock price declines, the LEAPS call option may lose value, and the income from the sold call options may help offset some of the losses. Now let's dive deep into detailed understanding of poor man's covered calls, the best secret in options. The poor man's covered call strategy, when properly executed, can offer several intriguing advantages that may amaze investors. 1. Lower capital requirement. One of the most appealing aspects of the poor man's covered call is its ability to replicate the profit potential of a traditional covered call strategy while requiring significantly less capital. By using deep-in-the-money LEAPS call options instead of buying the underlying stock, investors can participate in the upside potential with a reduced upfront investment. 2. Leverage. The deep-in-the-money LEAPS long-term equity anticipation securities call option offers investors leverage and amplifies their exposure to the underlying asset. This means that for a relatively smaller upfront cost compared to buying the stock outright, investors can achieve a similar profit potential. When a LEAPS call option is deep in the money, it means that the option's strike price is significantly below the current market price of the underlying asset. As a result, the option has a high intrinsic value, representing a substantial portion of the stock's value. 3. Risk management. The poor man's covered call strategy incorporates elements of risk management by utilizing the income generated from selling short-term, out-of-the-money call options. This income serves as a cushion or a buffer against potential losses in the LEAPS call option if the stock price declines. When implementing the strategy, the investor sells call options with strike prices above the current market price of the underlying asset. These call options are considered out of the money because they have no intrinsic value at the time of sale. The investor collects premiums from selling these options, generating income. 4. Time decay advantage. The poor man's covered call strategy benefits from time decay, also known as theta decay. The short-term, out-of-the-money call options that are sold have a higher rate of time decay compared to the deep-in-the-money LEAPS call option. This means that, over time, the sold options lose value faster, resulting in additional income for the investor. 5. Potential for income generation. The strategy offers an opportunity for consistent income generation through the premiums received from selling the short-term call options. As long as the stock price remains below the strike price of the sold options, the investor can continually collect premiums throughout the life of the strategy. 6. Flexibility and adaptability. One of the advantages of the poor man's covered call strategy is its flexibility, which allows investors to adjust their position as market conditions change. This flexibility stems from the ability to choose different strike prices for the deep-in-the-money LEAPS call option and the short-term out-of-the-money call options based on their outlook for the underlying asset. Investors can select different strike prices for the LEAPS call option depending on their expectations for the stock's price movement over the longer term. If they anticipate significant price appreciation, they may opt for a lower strike price on the LEAPS call option to capture more upside potential. In summary, the poor man's covered call strategy is a more affordable alternative to traditional covered call strategies, suitable for investors with limited capital. It involves using deep-in-the-money leaps call options to replicate the profit potential of owning the underlying asset. However, they should be aware of the risks associated with stock price declines and the potential loss of value in the leaps call option. Example of poor man's covered call. Imagine you have been eyeing a particular technology stock, XYZ Incorporated, but you have limited capital to invest in it. The stock is currently trading at $100 per share, and you believe it has the potential to increase in value over the next year. Instead of buying the stock outright, you decide to implement the poor man's covered call strategy to participate in potential gains while reducing your initial investment. You do some research and find a leaps call option for XYZ Incorporated with a strike price of $80 and an expiration date 1 year from now. The premium for this option is $25 per share. You purchase one contract of the leaps call option, costing you a total of $2,500. $25 premium, x 100 shares per contract. This deep-in-the-money leaps call option closely tracks the price movement of the stock. To generate income and further offset your investment, you sell short-term out-of-the-money call options against the leaps call option. Let's say you sell monthly call options with a strike price of $110, receiving a premium of $5 per share. Each month, you collect $500, $5 premium, x 100 shares per contract, from selling these call options. Over the course of the year, you continue selling the short-term call options and collecting income while holding the leaps call option. If the stock price of XYZ Incorporated rises, the leaps call option will also increase in value, allowing you to potentially profit from the price appreciation. The income generated from selling the call options helps offset any potential losses or decreases in the value of the leaps call option. At the end of the year, you evaluate the performance of your poor man's covered call strategy. If the stock price of XYZ Incorporated has indeed increased, you may choose to sell the leaps call option for a profit and realize the gains from the stock's appreciation. The income collected from selling the short-term call options provides additional returns on your investment. In conclusion, the best secret of the poor man's covered call strategy is its ability to provide an affordable and accessible approach to participating in the potential gains of a stock while generating income. By utilizing deep-in-the-money leaps call options instead of buying the underlying stock, investors with limited capital can replicate the profit potential of a traditional covered call strategy. This strategy offers leverage, risk management through income generation, and flexibility in adjusting positions. However, it's essential to understand the complexities of options trading and carefully assess risks before implementing this strategy. The best secret lies in the strategy's potential to unlock opportunities for investors with limited resources to engage in the market and potentially achieve favorable outcomes. However, as with any investment strategy, it's important to do your research and consult with a financial advisor before making any decisions. We hope you found this video informative, and we encourage you to like, subscribe, and leave a comment below with any questions or feedback. Thank you for watching, and we look forward to bringing you more informative content in the future. And we'll see you in the next video.